Imagine waking up to see silver dropping fast, headlines screaming about billions in metal being dumped, and traders everywhere asking the same question at the same time. Is this just another shakeout, or is something much bigger starting right now? If you've ever watched precious metals suddenly fall for no obvious reason, only to recover later and leave most people confused and frustrated, then stay with me because what's lining up around this potential silver price collapse is not random, not accidental, and definitely not new. The idea that as much as $14 billion worth of gold and silver could hit the market in a short window sounds shocking on the surface, but when you break it down step by step, it fits a pattern we've seen repeatedly across modern financial history, especially when paper markets, derivatives, and investor psychology collide with real physical metals. To understand why people are even talking about a silver price collapse beginning on a specific day, you have to first understand how silver is actually priced. Most people assume the price of silver reflects physical supply and demand, like how much is mined, how much is used in solar panels, electronics, or jewelry, and how much investors want to hold. But in reality, the daily price of silver is dominated by paper contracts, futures, options, and leverage positions traded on major exchanges. These contracts represent far more silver than actually exists in deliverable form, sometimes by a factor of hundreds to one. That means the price can be pushed sharply up or down without a single physical bar changing hands, simply through large, concentrated trades. When you hear about billions of dollars in gold and silver sales, in many cases this refers to paper selling, not truckloads of metal being dumped on the street. Now let's talk about that $14 billion figure because it sounds dramatic, but it becomes more logical when you translate it into market mechanics. On futures exchanges, a relatively small amount of margin controls a very large notional value of metal. If a few large players decide to aggressively sell futures contracts in a thin trading window, especially during low liquidity hours, they can create a sudden waterfall effect. Prices drop quickly, stop-loss orders are triggered, algorithmic trading systems jump in, and before most retail investors even understand what's happening, silver is down several percent. Add gold to the mix, which often trades in tandem with silver during risk-off or risk-on events, and suddenly you're looking at massive notional value changing hands in minutes or hours. That's how you get multi-billion-dollar moves without a fundamental shift in physical supply overnight. But why would anyone want to trigger a sharp drop in silver right now? This is where broader market context matters. Precious metals do not trade in a vacuum. They are deeply connected to interest rates, the strength of the US dollar, inflation expectations, and overall confidence in financial systems. When real interest rates rise, meaning interest rates adjusted for inflation, gold and silver often struggle in the short term because they do not pay yield. If bond yields jump or the dollar strengthens sharply, funds may rotate out of metals and into cash or fixed income. At the same time, large institutions managing trillions of dollars often rebalance portfolios at specific times, such as quarter ends, options expiration weeks, or around major economic data releases. These moments create perfect conditions for sudden, violent moves. There is also the psychological element, which is just as important as the financial one. Silver is notorious for shaking out weak hands. Historically, silver tends to fall faster and harder than gold during market stress, only to outperform dramatically later. This volatility discourages long-term holding for many investors and makes silver an ideal target for short-term trading strategies. If you look back at previous sharp drops in silver, whether during the 2008 financial crisis, the 2011 peak and crash, or the pandemic panic in 2020, the pattern is strikingly similar. Prices collapse quickly, sentiment turns extremely negative, headlines declare the end of the bull market, and then, once selling pressure is exhausted, silver begins a powerful recovery that leaves late sellers behind. Another critical piece of this puzzle is the role of options and expiration dates. When large numbers of call and put options are set to expire, price often gravitates toward levels that cause the most options to expire worthless. This is sometimes called max pain, and while it's not a conspiracy theory, it is a documented phenomenon driven by hedging behavior. If silver has a large concentration of bullish bets at higher prices, a push lower near expiration can wipe those out efficiently. When people talk about a collapse beginning on a specific Friday, they are often pointing to these technical and structural factors rather than a sudden change in the real-world usefulness of silver. Now let's bring gold into the conversation, because gold and silver are linked, but not identical. Gold is primarily a monetary metal, held by central banks and investors, as a store of value. Silver is both a monetary metal and an industrial metal, meaning it is heavily used in manufacturing, especially in green energy technologies like solar panels. This dual role makes silver more sensitive to economic slowdowns. If markets start pricing in weaker growth or recession, industrial demand fears can pressure silver more than gold. At the same time, gold may be sold alongside silver during liquidity events, not because it has lost its appeal, but because investors sell what they can to raise cash. This is why you often see gold fall sharply during market panics before eventually recovering as a safe haven. The idea of $14 billion in combined gold and silver selling also ties into the size of institutional players. Hedge funds, commodity trading advisors, and large banks operate on scales that most individuals never encounter. A single fund adjusting its exposure can represent billions in notional value. When multiple players act in the same direction, whether due to similar models, risk limits, or macro signals, the effect can look coordinated even if it's simply systemic behavior. This doesn't mean metals are doomed. It means the paper market is doing what it has always done, amplifying short-term moves far beyond what physical fundamentals alone would justify. At this point, you might be asking a crucial question. Does a potential silver price collapse mean silver is a bad investment? And the honest answer is that it depends entirely. Rely on your time horizon and your understanding of what you own. Short-term price drops are painful, especially if you're over-leveraged or emotionally invested in daily price action. But for long-term holders, especially those focused on physical silver, sharp declines have historically been opportunities rather than disasters. Physical silver does not disappear when futures prices drop. Mines do not suddenly produce silver at a loss indefinitely, and industrial demand does not vanish overnight. In fact, prolonged low prices often lead to reduced mine supply in the future, setting the stage for higher prices later. It's also important to separate headlines from reality. A paper-driven price collapse does not necessarily mean you will suddenly find physical silver cheaply available everywhere. In past downturns, physical premiums have often risen even as spot prices fell, reflecting tight supply and strong retail demand. This disconnect confuses many new investors, who expect lower prices to mean easier access, only to find empty shelves or long delivery times. Understanding this difference between spot price and physical availability is essential if you want to navigate the precious metals market without constant frustration. So when you hear talk of a silver price collapse beginning on Friday, driven by massive gold and silver sales, the real story is not about a single day, but about the structure of modern financial markets. It's about leverage, liquidity, psychology, ND timing. It's about how paper claims on metal can overwhelm real-world fundamentals in the short term, creating fear and uncertainty. And it's about how those very moments of fear have historically laid the groundwork for the next phase of the cycle. Because when selling pressure is exhausted, value doesn't disappear, it waits, because once fear reaches a certain intensity, markets begin to reveal what was hidden beneath the noise all along. In the case of silver and gold, that underlying reality is the tension between paper promises and physical scarcity, a tension that becomes sharper every time prices are pushed down aggressively. When prices fall fast, it feels like confirmation that something is fundamentally wrong, but in commodities, especially precious metals, rapid declines often signal stress within the system rather than weakness in the asset itself. To understand why, you need to look beyond price charts and into the plumbing of the market, where leverage, inventories, and real-world demand quietly tell a very different story. Start with inventories, because this is where theory meets reality. Silver inventories held at major exchanges and approved vaults have been under pressure for years. While reported numbers can fluctuate, the trend has been one of drawdowns rather than accumulation, especially in categories that represent readily deliverable metal. This matters because futures contracts ultimately rely on the credibility that metal can be delivered. If demanded. Most contracts are settled in cash, not metal, but confidence in that system depends on the assumption that delivery is possible. When prices fall sharply and investors with long-term conviction step in to buy physical silver, those inventories can drain faster than expected. The paper price may say silver is cheap, but if bars and coins become harder to source, the message from the physical market is very different. Now layer in industrial demand, which is often misunderstood. Silver is not just a shiny store of value, it is a critical input in modern technology. Solar panels, electric vehicles, medical devices, and electronics all rely on silver's unmatched conductivity. Unlike gold, much of the silver used in industry is consumed rather than stored. Once it's embedded in a solar panel or circuit board, it's not economically recoverable at scale. This creates a slow but persistent drain on above-ground supply. Even during economic slowdowns, many of these uses continue, especially when governments are pushing long-term infrastructure and energy transitions. So while traders may sell silver futures on recession fears, the physical flow of silver into industry does not simply stop. This brings us to the role of mining, another piece often ignored in short-term price discussions. Silver mining is not as flexible as people assume. A large portion of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is tied to the economics of entirely different markets. If base metal demand slows and mines reduce output, silver supply can fall even if silver prices are low. This creates a paradox where lower prices do not necessarily bring more supply, they can actually constrain it. Over time, this imbalance has consequences, but those consequences rarely show up immediately in the price, especially when paper selling dominates. So why does the price still collapse in the face of these fundamentals? The answer lies in positioning and leverage. Futures markets allow traders to control large amounts of silver with relatively small capital. When sentiment shifts, these positions can unwind violently. If a fund is heavily long silver and prices start to fall, margin calls can force selling regardless of conviction. This selling pushes prices lower, triggering more margin calls, creating a feedback loop. None of this requires a change in physical demand or supply. It's purely financial pressure. And when large players unwind positions simultaneously, the notional value involved can easily reach billions of dollars, giving rise to dramatic headlines about massive selling. Another factor that often coincides with sharp drops is the broader risk environment. When equity markets become unstable, or when there is stress in credit markets, investors seek liquidity. In those moments, almost everything gets sold, including assets that are supposed to be safe. This is why gold and silver can fall alongside stocks during the initial phase of a crisis. Cash becomes king, not because it's attractive long-term, but because it's immediately usable. Only after the dust settles do investors reassess risk and begin to move back into assets that protect purchasing power. This sequence has repeated across multiple crises, yet it continues to surprise people every time. It's also important to address the idea of intent versus outcome. People often ask whether silver price collapses are engineered or manipulated. The reality is more nuanced. The structure of the market allows certain behaviors that predictably lead to sharp moves. Large players act in their own interest, using tools that are legally available to them. The outcome can look manipulative, especially to those on the wrong side of the trade, but it is largely a function of incentives, liquidity, and timing. Understanding this doesn't make the moves less painful, but it does make them less mysterious. For individual investors, the key question becomes how to respond. Panic selling into a sharp drop locks in losses and transfers metal or capital from emotional holders to disciplined ones. On the other hand, blind buying without understanding risk can be just as dangerous. The most successful participants in precious metals tend to have a clear framework. They understand why they own silver or gold, what role it plays in their portfolio, and how much volatility they are willing to tolerate. They also understand the difference between trading paper price movements and accumulating physical metal for long-term protection. Consider an analogy. Imagine the ocean during a storm. The surface is chaotic, waves crashing unpredictably, making it look dangerous and unstable. But beneath the surface, deeper currents move slowly and steadily, largely unaffected by the wind above. Paper markets are like the surface, reactive and volatile. Physical supply, industrial demand, and monetary debasement are the deeper currents. When you focus only on the waves, it feels like everything is out of control. When you understand the currents, you see that storms come and go, but the direction of flow changes much more slowly. This perspective becomes especially important when you factor in monetary policy and debt. Governments around the world continue to carry historically high debt levels. Servicing that debt becomes harder when interest rates rise, creating pressure on central banks to eventually ease financial conditions. While short-term rate hikes can hurt metals, long-term debt dynamics are supportive of assets that cannot be created at will. Silver and gold have played this role for thousands of years, not because they are perfect, but because they impose discipline on systems that otherwise tend toward excess. So when silver prices fall sharply and headlines warn of collapse, the critical task is to separate signal from noise. Ask yourself what has actually changed. Has silver become less useful? Has it suddenly become abundant? Has the monetary system become more stable and less reliant on debt? In most cases, the answer is no. What has changed is positioning, sentiment, and short-term expectations. Those factors matter for price, but they do not define value. As we look ahead, the next phase of this story depends on how long selling pressure lasts and how participants respond. If selling exhausts itself quickly, prices can stabilize and recover just as fast. If fear feeds on itself, the decline can extend further than seems reasonable. Both outcomes have historical precedent. What matters is not predicting the exact bottom, but understanding the process. Because once you understand the process, volatility becomes something you can navigate rather than something that controls you. And that understanding sets the stage for what comes next, which is where silver and gold may be headed after the dust settles and what signals to watch before the next major move begins when